In this video, guys, I want to talk about circuit breakers, limit up and limit down moves. Stick around. Hey guys, warm welcome to you. Alright, so with volatility comes the potential to hit what's known as limit up, a limit down, or what's otherwise called, with other slightly different variation of a limit, market-wide circuit breakers. So what is limit up and limit down? So limit up or limit down, if you were looking at the S&P 500 futures, Nasdaq futures, any equity, in fact any futures market, but for equities the numbers are slightly different. So let's just use ES, YM and NQ for now, which is Nasdaq, S&P 500, Nasdaq and Dow Mini. If they move plus or minus 5% pre or post market, then trading goes locked limit up. Now this is slightly different to a circuit breaker. We'll kind of explain in a moment the difference, but that prevents the market just going crazy with the pre-market futures or just going nuts on either side. So it's protected both sides. The slight differences with the circuit breakers is only to the downside. Market can go up as much as it wants, but it can't go down when it's actually trading. And I mean the market as in, we have the regular trading hours, the bell goes New York Stock Exchange, Nasdaq, those shares that are actually trading on the underlying market, that's when the market is open. Pre-market, we've got these limit up or limit down caps on price. They're different for other futures contracts. If you're trading some agriculture and stuff, there's a different number there, but they fundamentally work the same way. But it's plus or minus 5% for equity index futures. Okay, so let's go to the market-wide circuit breakers. So circuit breakers, what are these all about? So if the market falls by 7% and it's before 3:25 p.m., so kind of early in the, well, all throughout the day really, except for the kind of in the last hour, the market will halt for 15 minutes. In other words, all trading market wide. So we'll look at the S&P 500 as a benchmark here. So that's the one they use, and it's agreed that all exchanges will pause trading for 15 minutes. So it's all the benchmark is the S&P 500, and regardless of whether you're trading a share on the Nasdaq, that's the Nasdaq 100 or whatever, all US equities will halt for 15 minutes. After 15 minutes is gone, they can start trading again. So that's a level 1 halt. A level 2 halt, exactly the same parameters, exactly the same thing, a 15-minute halt if it's before 3:25 p.m. But this time it's a 13% move in the S&P. So it has to go down 7 and then down again to 13 before we get the level 2 halt. 15 minutes break, market wide, same rules apply. Okay, now a level 3 halt, and if we're in level 3 halt, boy, things are bad. A level 3 halt is 20% down in the S&P 500 again, halted across the market, market-wide circuit breaker, that's it, game over for the day. Everyone needs to cool off and stop that selling. So that's the way it works, guys. Now, we have seen circuit breakers hit very recently doing these videos. We've seen limit up, we've seen limit down, we've seen circuit breakers going off that have stopped the market falling. So, and they work really well, actually. You know, you kind of see the underlying technology behind it. You think, okay, does the job. Now, there's an argument to say, hey, should we be disrupting, free price in terms of price discovery, and isn't that the whole point of it? And there is an argument for that, but the counter argument is that, hey, sometimes people just need a little bit. It's not as if we're stopping trading unless it gets to there, of course, but sometimes people or algos are going crazy, people are getting a bit too excited about stuff and panicking, and the 15-minute halt lets everyone just stop, relax, the algos reset, and if there's any kind of errors that are going on, maybe could stop any further just crash that's based on rogue algos or just panicky fear. And 15 minutes is enough time to hopefully let everyone kind of gather their senses, gather their thoughts, and if they still want to sell after that, then that's fine. They can sell again down to minus 13%, and if they still want to sell, they can sell after that. So it's just putting that little break in things. Now, going back to the limit, guys, limit up or limit down. So slightly different. If you watch the futures as they go to limit up or limit down, so imagine they go to limit down, you basically get to a point where you can't sell any lower, but you can actually go higher. So if we imagine let's just kind of round it off and say the bid was 100.01 and the ask was 100.02. I don't know what market that would be, but imagine that was it. and that was limit down. That was going down -5% pre-market, was limit down. Now what would happen is you can't sell anymore. The market is still trading. You can only buy, you cannot sell. So what happens is offers tend to get stacked up here. You get 100 contracts, you get 1,000 contracts, you get 50 contracts, 25. Everyone stacks up there because that's the only way they can sell. If someone buys at 102, if you're sitting on the offer, you can sell, but you cannot sell any lower at that 01 bid until the market opens again, and then you can sell wherever you like, and we're into the market-wide circuit breaker scenario here. So sometimes what we have seen recently is the price has come down really hard to the limit, and it kind of sits there. So it's still open, it's popped off the limit, come down to the limit again, and maybe popped off and gone back up. So the limit, when we're in the limit up or down scenario, it can still trade, but just can't go any lower. Now we have seen also scenarios where we see markets go limit up, and they've come back and do unchanged. Volatility is unprecedented at the moment when I'm filming this. Lots going on, so it's worth understanding how these kind of things work and how they can affect you. Now, some people, very finally guys, quickly, some people say, okay, well if I buy on the limit, that's fine, I can't go any lower. That's true, but then when we open, you can go down 13%. And in some scenarios, if you've read some of the books from guys who are trading many 80s, 90s, prices go instantly to the limit. So if you're trading, slightly different with stocks because there's lots of stuff trading, but if it's brutal selling, you may not be able to get out. You might say, okay, that's great. But then when the market opens, the market may open and go straight down again. Halt, my market may open and go straight down again, and you can't trade. Now, that's pretty unlikely. I say that with caution at the moment. But if you're trading just futures, now obviously there's an underlying market with this, but you're trading just futures, many of the futures contracts don't have an underlying kind of market. If you're looking at maybe crude oil, or you're looking at some of the agricultural stuff, you've heard stories, perhaps if you read the Market Wizards book, of people trading, there's lot limit down for the day, next day it opens lot limit down, and they cannot get out of their buy because they can't sell until it comes off that limit the next day, and by that time, yeah, it's devastation, isn't it? Okay guys, that is lot limit down, or limit down, limit up, and circuit breakers. Take care out there, bye-bye.